the day of the December Fed meeting. We already had the bearish divergences at the December top. The S&P peaked up on the 6th. The Dow peaked on the 4th. Dow and the Russell sold off sharply. The S&P went sideways. And I told you if we had a downward resolution of the triangle, which we got with the Fed day on the 18th of December, I told you we get a bigger sell-off and likely go back and fill the gap from the election. I talked about moving towards the trend line from the 2023 low. Did that on January 9th and 10th as we were approaching the gap fill and the trend line. I told you that we would likely bottom the following week surrounding the inflation data in January, the inflation data being released in January, and we did. I told you that on the 9th and 10th, on Thursday and Friday, that we'd be bottoming the next week. My signals indicated that was likely going to be the case. Bottomed on January 13th, very next day after the 10th, that Monday. That time I told you, as we were bottoming that week, I talked about the value line geometric index and told you why we were going to go to a new high. I told you we'd be diverging with the S&P up here in the upper window would be diverging with value line, massive divergence. We did see the S&P go and make a new high. Value line is still not doing it. The S&P is likely not done. Neither is value line. I'll show you this up close in a second, but I just want to point out as we zoom out here, over history, you can see the divergences have marked major tops. Look at the major top at the bursting of the tech bubble, the divergence that formed, value line making a lower high, the S&P making a higher high with the top. It dropped 51% with the bursting of the tech bubble. NASDAQ dropped about 82%. Another divergence at the 2007 top. This time we dropped 58%, and we had the bear market. By the way, in my last video, I talked about the valuations being with the Buffett indicator, market cap to GDP, being at extremes. Over here is nearly 150%. Told us that we are going to have a long period of a drawdown and that you're going to get a couple crashes over the next decade. That's what these valuations tell you. We saw that from 2000. We got this sell-off and this sell-off. We went back up and went 25 points above the 2000 high at 1550 over here, 1575, and we got another crash and we made a new low at 58% lower. We went nowhere. If you bought the top in 2000, you didn't start making money until 13 years later. What high valuations, like I talked about in my last video. If you didn't see the Buffett indicator, my last video, I'll link it at the end of this one. Go watch it. Very interesting. The market is more overvalued than any other time in history. Right now, go back to the 80s to the 2000 top, and I don't have all the data here, but if we go back, you got this massive bubble, and oh, that's the bubble. But yet, this isn't a bubble. You know, I mean, people are so out of touch with reality. Because the market doesn't top and crash immediately, people become complacent as they do at every top and believe, oh, it hasn't happened, so it's not going to happen. And that's called complacency. Now, we've had other diversions, not just the bear market here with 51%, 58%. We had it here in 2000 at the 2015 top. We had the divergence, and that gave us a 17% decline. We had a divergence develop between the 2018 peak and 2020, and we had a divergence, and we dropped 35%. We had a divergence in 2022 at the top there, with value line making a lower high, and the 2022 top made a higher high. S&P 500, we got a 27.5% sell-off. Now, again, people that told us that that wasn't going to happen, now telling us, oh, that's the bear market, it's already over, we're only 2 years into the new bull market, and we've got years and years more of the new bull market. Bull market never ended. Well, we crashed more than 20%. That's a bear market. That's some analyst definition based on percentages of a bear market. It's a bunch of nonsense. Was this the shortest bear market in history? The drop here of 3.5 weeks? Shortest bear market in history? We dropped 35% with the pandemic. We dropped 20% in 2018 in a month, a little bit less than a month. That was a 20% decline. That wasn't a bear market. We dropped in 2011. We dropped 21%. Was that a bear market? No. These were major corrections in the larger bull market. The bull market never ended. So, the most overbought in history because the Fed has been meddling with the markets with all the QE And then we have the government and the bailout, pardon me, the stimulus. All this money is working its way into the market, just making it artificially going higher. It's being artificially propped up. The divergence right here. I think you're going to get a divergence right here, but you have this larger divergence. Look at this. Value line's not moving to a new high above the peak over here where we peaked with the S&P in 2022. The S&P's moving to new highs, but value line isn't. And this is telling us, hey, you're forming a major top. You're forming this massive divergence, and we're going to get one right here. And we already have it, but it's probably going to be better defined in the more recent price action. Now I'm going to blow this area up right here so you can see this up close and what I'm talking about. Between the 2022 peak and right now. Now, I'm blowing this area up again. Here's the 2022 peak. Let me fix this. My trend line moved on me here with value line. Again, value line got a lower high at the 2022 top, and it diverged with the S&P. As we've seen at all those other tops, it did diverge. S&P went and made a new high. Well, we didn't move above the November high with value line, and we had the sell-off. Now we have this massive divergence between the S&P going higher, value line not. As the S&P goes up to finish minor wave 5 and complete the cycle top, intermediate wave 5 and primary wave 5 and complete the whole kit and caboodle. That's an American expression that means the whole enchilada, the whole thing. It's going to complete the topping process, the whole enchilada. We get this final push with our final phase, the final phase of the blow-off top. Markets end with blow-off tops, and that's what we have here. We're getting the final phase of the blow-off top. Now, I believe the value line's already peaked. I think we're going to diverge like we did over here. I think it'll end up setting up a lower high as we move closer to this trend line right here, or maybe even tag it. I think you'll get a lower high, and I think when that happens and the S&P goes up higher into the trend lines I've been talking about, I think you have that divergence complete in the more recent price action right here, just as we did back over here, and you'll complete a top right there, and you'll also have this massive divergence between the two, marking a major top, and again, likely not see these highs for at least 10 years once we get the peak. At least that's what valuations tell us, that you're going to have a drawdown. Now, that doesn't mean we go down for 10 years. That means we get a bear market, we get another bull market, we rally up, likely make a lower high, and then you get another bear market. And this is likely going to take us into the 2030s. We're going to have a crisis now, and then we're going to have the debt crisis later, probably in the early 2030s. Now, Elon and Doge might buy us a little bit more time with the Department of Government Efficiency cutting the waste, fraud, and abuse. Again, the economy has been artificially propped up before the election, and we spent over $7 trillion in 1 year. $2 trillion, over $2 trillion, $2.2 trillion in artificial really stimulus for the economy prior to the election, with 2.2 in government deficit spending. That's being removed with Elon Musk and Doge taking a wrecking ball to government spending. So again, that will allow the artificial stimulus that's been propping up. We've already had the recession indicators triggered before the election. It's about to happen, but the artificial stimulus, the deficit government spending, that's going to be removed. And we're likely going to see a major top and not see these levels for at least 10 years once we peak and begin to turn down and move into the bear market. You're going to have a bear market, you're going to have a bull market, and then you're going to have another bear market. But possible, and again, possible, a little bit more time if they can control of spending, but coming. The valuations are telling us that over the next decade, returns are going to be very low because you're going to have a crash or two along the way, which is setting up right now. So I think we're going up in here, and I think you're going to diverge with the value line, and then I think you're going to see a top and fall by a crash. And I think it will be, again, as I've been predicting, an inflation freakout. I've been warning you that the inflation data is going to turn higher. We're now seeing evidence of that. 2 more reports, one on March 12th, another one on April 10th, with the CPI data. Be in early April, maybe April 1st, a deadline, possible deadline for implementing the new reciprocal tariffs It could get dragged out a little bit longer in the next 6 weeks to April 1st or so, or on into early April. But we're going to get the CPI data on the March 12th and then March 12th and April 10th. And again, I expect you're going to see the inflation data tick up, and we're going to see the inflation freak out with the tariffs. And again, the media is already doing their best to convince us that these inflation reports, it's the tariffs. The tariffs have been paused with Canada and Mexico. The tariffs being delayed with our new tariffs. The tariffs we have are with China, an additional 10%, and then now a few days ago on Monday evening, the president signed the executive order for the tariffs on steel and aluminum. And the inflation data we have, it doesn't even reflect the tariffs. But I told you the inflation was going to go higher. Why? Because of the government spending, $2.2 trillion in 2024, and because the money supply is increasing. It's the Fed policies that are doing that. The media is going to do everything to try to convince us we're going to have this trade war, which right now we don't. Maybe that changes, but they're going to do everything in their power to inflation freak out, and then we're going to see the data, the inflation indexes rise. Not because of tariffs. Tariffs don't cause inflation. Because of the increase in the money supply and the government deficit spending, I'm telling you, we're going to have inflation. But the Fed is still going to cut. We get the inflation freak out, which is going to come at a little bit higher levels for the S&P 500. So be watching this divergence between the S&P and value line. It's going to mark the top. And we could see that those tariffs start coming into play when they begin, and that could be as soon as April 1st or in the early part of April. That's where I think we're going to likely peak. Nowhere since November. We've gone sideways. That has bought us more time to go higher, dragging out the topping process, but it's likely going to be the tariffs, the rise in the inflation data that will create the stock market top, along with the likelihood the bursting of the AI bubble. Please support the channel with the link directly below that allows me to be able to provide you this information. If you like the charts, you like the indicators, let me know that by supporting the channel. I don't have any sponsors. I turn all those offers down. I don't want to sell you things. But I need you to partner with me in order to make it work. If you like this information, if you like the charts and indicators, let me know that by supporting the channel today. Just follow the link below to take you to a secured site, and you can donate any amount you want. If you could take a moment to step up to the plate and help out, I would really, really appreciate that. Let me know you want this information and that you like this information by supporting the channel today. Thank you so much for your consideration for that. We're talking about some recession indicators. I'm always asked about the recession indicators. There's a lot of them. I don't always have time to show them to you, but I try to work them in on weekends. We have the holiday here. I thought I'd show you a few, and there's plenty of them. Last few weeks, I've talked about quite a bit of them. There's plenty more that I haven't shown you. Either signals that are suggesting a recession or signals that have already been triggered that are so recession's about to happen. And some signals triggered recession indicators signals. Others are flashing warning signs. So I'm going to talk about a few here. People always ask me, what are the different recession indicators? And here I'll share a few with you. In previous weeks, I've shared others with you. I'll continue to try to do that from time to time. Now, this is personal interest payments. What usually happens here is personal interest payments begin to top out, and we start seeing this downturn with it, as we're seeing right now, and that's usually associated right before the recession starts, and that's what we've seen in the past, as we see really this negative correlation between the unemployment rate. When it begins to spike up and rise, we see personal interest payments begin to roll over and start to fall. Now, we have that going on right now. It's a really good warning sign, a red flag that we're moving towards recession, as we saw right before the pandemic, and with the pandemic and the recession associated with that, the shutting down of the economy in 2007, the recession there, and in 2001, the 2001 recession, where again the market began to turn down, and we began to see this downturn in personal interest payments. Personal interest payments refers to the costs that individuals incur for borrowing. When they're borrowing money, it rises. And when less willing to take on debt, and when they're not taking on debt, it falls. And this is associated with economic downturns. So again, it is the cost individuals incur for borrowing money. There's a negative correlation between interest payments and the unemployment rate. As the unemployment rate rises, as it's starting to turn up right now, again to see the interest payments, personal interest payments begin to roll over, and it's associated with the recessions over and over again, beginning to turn down. That's exactly what we have right now. Now, personal interest payments, this is, mortgages, auto loans, credit card payments, whatever kind of debt people are racking up. As the unemployment rate rises and we start to move into recession, is what happens is this begins to turn down ahead of the recession. And then as we move into the recession, losing their jobs, and the ones that keep them are less willing to take on new debt. And the ones that lose their jobs can't see this decline. Because as the unemployment rate is rising, fewer people are working and earning wages, leading to a reduction in disposable income. And that's really why this declines. With an economic downturn, people prioritize the essentials and are less willing to take on new debt. And that's why it's a very, very good indicator that is, again, really having a negative correlation with the unemployment rate. The unemployment rate rises, personal interest payments peak and begin to drop, and that's exactly what we have right now. So again, I think it's a huge red flag that recession is on the horizon, because it's doing right now what it does right before recession shows up. Right now the narrative is, we're going to have this soft landing. The Fed, you got Powell telling us that it's clear we've avoided a recession at the December FOMC press conference there. Everybody believing that we now have had a soft landing out of the Fed. Powell last week was just complimented for saving us all from the recession. One of the senators during his hearing with his public testimony there, complimenting Powell for the soft land and the Fed for the soft landing, which we're about to have a recession. The Fed does what they always do before in a recession and tell us we're going to have a soft landing and deny all the warning signs. That's what they do. I've been to this rodeo before. It's the same thing. But if you look at some of these indicators that I'm showing you, they're telling us a different story. They're telling us that something is getting ready to happen. Here we have people not in the labor force that want a job, but they're discouraged workers. Again, another warning surrounding the labor market, suggesting we're about to move into recession. Again, tend to get this spike of those not in the labor force, and you tend to break the trend line and begin to turn upward, breaking the downward trend, starting to move into an upward trend before the recession begins. We had that in 2001. We had that in 2007. Into 2008 there, as we started the recession in December of 2007. We had it here right before the pandemic. Again, this is a self-imposed shutdown of the economy. We're getting it right now. We're doing the same exact thing. You're seeing this jump in those not in the labor force that want a job but are discouraged workers. And that's what we're seeing right now. And again, this is a huge warning sign. Again, what we have right now sure looks like what we had over here, again, right before these recessions start, and right over here. And that's why I'm telling you, again, there's a lot of warning signs, but people want to dismiss it and ignore the warning signs. This is a huge red flag, because this is what we've seen right before the recession starts. These gray areas are the recessions, and it happens right before it starts. That other signals, reliable recession indicators, are telling us, hey, it's about to start in the not too distant future. And I think that this signal is in agreement with that. But again, People like to bury their heads in the sand and say this time is different. Oh no, we have this soft landing. We're only 2 years into the new bull market. It's going to go on for many more years. And again, the bull market never ended. We're likely witnessing a stock market topping process that I still think the S&P goes higher. I think that it will peak at my target levels, the trend lines, and we will followed by a 20% drop to kick off the new bear market. The market will begin to decline just a month or two ahead of the recession showing up. We rally with the tax cuts and then start selling off with the tariffs. From April, could see the rally going for another, 6, maybe 8 weeks. Inflation data tick back up, have the tariffs kick in, and the market moves into freak-out mode. Inflation, freak-out, recession will show up shortly thereafter, and it's looking more and more like it might be the second quarter here. I talked about the recession showing up in the first or second quarter. That's what I was looking for in the fourth quarter of 2024. I told you that's what I was looking for, is a recession to show up in either the first or second quarter of 2025. It looks like that's likely going to be the case. Huge warning sign here. Now the market's closed on Monday. I talked about in my last two updates over the weekend here. I talked about crazy week we had with the inflation data rising and the tariffs, new tariffs on steel and aluminum, and the announcement of the coming reciprocal tariffs. Just a crazy week. But from time to time, I show you different signals that are showing that, hey, we're about to have a recession. Some signals are flashing a recession. Others are warning that a possible recession could be on the horizon and just flashing red flags. So again, just want to talk quickly about a couple of things. This week we got industrial production, which is giving us a red flag, and capacity utilization, which is the business cycle and warning we're about to get a recession. Now, capacity utilization is ticking up a little bit. It came in just over expectations and a little bit higher than the previous reading, but still warning that we're about to move into recession. It is the business cycle. Industrial production is forming a divergence with the S&P 500 here in the monthly time frame. You can see that, and again, this is very similar to what we saw before the recession in 2020. There was that divergence there. The fact that we've stopped making new highs and we've just had this choppiness as we've risen back up on the S&P 500. So it's just a red flag. Often get industrial production beginning to turn down once these divergences form, beginning to turn down just ahead of the recession, or as we start the recession here in 2007, late 2007 there. Again, the diversions here starting to turn down just before the recession. That's usually the case. Now, there were concerns about recession there in 2015 and 16 because the Fed ended its third round of quantitative easing in October. I believe it was October of 2014, and we saw some signals start to show signs of concern. And we had President Trump win the election in 2016 later, after the volatility we got in 2015 and 16 surrounding the devaluation of the yuan and other concerns about recession. We saw the Trump tax cuts from his first term, deregulation, ignite another round of stimulus into the market. Hopes of the tax cuts gave us this run up after the election on up into the 2018 level where we started to get more volatility. But a recession, even though we did get some warning signs on different indicators, it was never officially declared, and other really good recession indicators did not mark that was going to happen. But you did see things like industrial production begin to drop. Some other warning signs like that when QE, the third round of QE ended in late 2014. It's a red flag. Now here I have the global capacity utilization index. It's the average percent of productive capacity being used by industries across the world. So it's looking at how efficient the global economy is going. I've marked the 80 level right here. Above 80 or rising and moving towards it are signs of strong demand, recoveries, economic recoveries, boom cycle. These kinds of things are associated with that. A strong recovery and a strong economic expansion, global economic expansion, usually gets above the 80 level and stays there. And again, in recent years, there's been a struggle to do that. But we're rolling over here. And again, we're turning down after the 2022 peak there, similar to the rolling over. And again, oftentimes the rollover here, the rounding top or the peak and the decline just ahead of the recession or as it begins. And the United States unemployment rate here, because again, the rounding bottom tends to have a negative correlation with global capacity utilization. See here, that's exactly what's going on right now. We have this rounding. We did turn up with this month's reading, but it's still rolling over and you're still below 80 and it's still in a downtrend. And this is what happened before the shutdown of the economy there with the pandemic. We saw it turn down as the recession began in 2007. We saw it turn down ahead of the recession in 2001 and begin to sharply drop, which is what we're seeing right now, just before the recession started. Same thing over here in the early 90s, back in the 70s and 80s. Again, it either peaks and begins to turn down as a recession is beginning or a warning sign right before it. And right now we're seeing it turn down and it's still struggling. This is a huge, huge warning sign. And in 2014, we stopped QE and we did see things turned down ahead of the 2016 election on a lot of different indicators, but it was never officially declared a recession, and a lot of recession indicators were just not triggered. See some signs of weakness like we did with industrial production and here global capacity utilization. This is another warning that, hey, recession is likely on the horizon. Declining and holding below 80 over as it's done just before the recessions as the unemployment rate is turning up and having that rounding bottom. We're getting that rounding peak here with global capacity utilization. The fact that it's declining and we have a weak number here holding below 80 is a huge warning sign of a possible recession that could be on the horizon. This is the business cycle, and it tends to turn down just before the recession starts, dropping below 80 or moving towards it, really showing the boom and the bust cycle. And again, you can see when it sharply declines, again, this is associated with the recessions, this is associated with the economic downturns and the weak demand in global economies. If we're not going to have a recession, then why is this doing this? Behaving the way it does and has done in the past before you get a recession. We had the uninverting of the yield curve on September 6, 2024. And a lot of the recession indicators were flashing in 2024, but the economy was being artificially propped up by all the government deficit spending. The Fed wasn't doing QE anymore, but with the Fed tightening, a lot of that was being offset by artificial government spending, artificially propping up the economy. Now that's all going to be removed. The artificial stimulus that was delaying it with government deficit spending be removed, and we'll have the recession, and you're going to see very soon. But we had, the uninverting of the yield curve in September ahead of the election. We had bomb roll trigger back in early August. These reliable recession indicators are warning we're going to have a recession. These are the indicators that the Fed is dismissing. We got the jobs report earlier in the month. I spent a lot of time talking about the SOM indicator. It's never been wrong. Yet Powell, when asked about that, dismissed it. Absolutely incredible. But usually you get the 10 and the 2 uninverting, and then after that the 10 and the 3 follow. And that means the recession is getting all that much closer. Usually the uninverting of the 10 minus the 3 month, not 3 year, the 10 minus the 3 year that we're looking at in this video, really when that happens, we're getting very, very close to the recession. Now we do have this trend line here on NASDAQ. Again, the rally can continue, a trend line I'll be watching. A lot of signals, and I've covered others pointing that we're about to get a recession. Other indicators are warning that are acting as red flags. And again, we had a lot of the signals, a lot of the recession signals have triggered in 2024. Here's a 10-year minus the 3-month, and that was triggered on December 13th. At an inverted yield curve, meaning it was below this red line, below zero, it was negative, meaning short-term rates were higher than long-term rates. That's an inverted yield curve. That means something's wrong with the economy. Uninverts, what we've had here on December 13th, when it uninverts, we're moving closer to the recession. And the 10-year, we've already had, before this December 13th date, we long before had the uninverting of the yield curve between the 10 and the 2-year. Sometimes right before the recession, it goes back into negative territory, and then you get your recession, or sometimes it goes sideways. But we're about to have a recession, and it's a steepening of the yield curve, and you're going to see it steepen even more 2025, and we're going to come up to this channel line here on the S&P, likely peak, and then begin to turn down sharply, and that's probably going to be an immediate 20% drop for a month, or over a month or two or three. Fed will panic, they'll do emergency cuts, and the market will rebound back up and get a counter trend. That's what's happened in the past. That's what we saw, the 2000 top and the emergency cuts in early 2001. We saw in 2007 with the beginning of the recession, and the emergency cuts in early 2008. Exactly. And again, both times we were told we weren't going to have a recession, yet we did. 2007, the Fed was all worried about inflation when they should have been concerned about the recession. Exactly the same monetary policy mistakes they're making right now. He's slashing rates right now, not pausing, telling us we're in a good place, and being all concerned and worked up about inflation. Should be concerned about the recession, but they ignore the signal here. This is the 10 and the 3-month. 2007, after we got the uninverting of the yield curve between the 10 and 3-month, again, the stock market shortly after that, and then we had volatility. We went back up and we went slightly higher, just about 20 points higher than that, and then we saw the steepening of the yield curve, and the bottom fell out of the stock market. Probably going to see something very similar to that. Market began to drop sharply. We dropped 20.5%, nearly 20.5%. That's where the Fed panicked, and they did the emergency cut in 2008, in early 2008 there, and it just produced a counter trend. Very similar situation in 2001, and also the tax cuts produced a counter trend. Now, right now, again, let me say this. I think the tax cuts are going to be part of the rally up to complete the blow off top. This is our current data right now in 2025. I think the tax cuts will give us the rally as all that in 2017 and late 2016 there with the election. So the tax cuts, but then I think it's going to be the inflation freakout that gives us a sell-off. So I think the tax cuts give us the rally. I think the tariffs and the uptick in inflation give us the decline in the peak and the top in the market. We rally. The deadline is March 14th for the tax cuts. Now, let me just say this about the tax cuts. This is just extending the tax cuts from 2017. This isn't the new tax cuts, the middle class tax cuts coming later in the year. Those tax cuts will likely be a buy the rumor, sell the news. This is right here going to be part of giving us a final climax high, the extension of the 2017 tax cuts. Later, they're going to try to get through the no tax on tips, the no tax on Social Security, the no tax on overtime, those middle class tax cuts. Rich people don't live off Social Security. Rich people don't get tips. Rich people don't get overtime. These are the middle class tax cuts, but they will likely be a counter trend rally, as we saw with the tax cuts in 2001, how they were a buy the rumor, sell the news event. So I think that that will be part of the counter trend. But the current tax cuts, the extension of the 2017 tax cuts, I think are going to give us this rally to the upper boundary of the channel. So just wanted to share with you my thoughts on the tax cuts, because I think we rally on the tax cuts, and then later I think we'll have a counter trend on the other tax cuts, the middle class tax cuts that are not in this current bill trying to go through. The Fed emergency cuts will be a counter trend later. I think the tax cuts, hopes of the tax cuts will be a counter trend later, and these kinds of things. That's the same thing we saw in 2001. Why do I say that? Because again, Wall Street, why are we rallying with the election? Wall Street loves Trump's economic policies. They love the tax cuts and the deregulation. They love it, but they hate his tariffs. They believe they cause inflation, which they do not. That's why I think we're going to get the rally here on tax cuts, hopes of tax cuts. Maybe there's some other catalysts. And then later in the decline, when we're declining, we'll get another, and the bear market has already started, likelihood later in the year, maybe by the summer or the fall, we get those other tax cuts, end up being a counter trend rally. So two different sets of tax cuts. I think both of them could influence the market. One with the counter trend with the middle class tax cuts later, and the tax cuts right now, the extending the 2017 tax cuts. It's going to be the tariffs, concerns about a trade war, and an inflation freakout, because we're likely going to see the inflation data continue to rise. The market's going to shrug it off for now, but later it won't. Or the inflation data rising. We have had a pause of the tariffs. Canada and Mexico, we've had a delay of the reciprocal tariffs. We just now, last week, got the tariffs on aluminum and steel. And we had the 10% increase in the tariffs on China. And all the inflation data we're getting is not reflecting any kind of tariffs. And again, it only reflects 10.5 days of the Trump administration where there were no tariffs yet. So inflation freakout is coming, but I think the tax cuts takes us higher. I think the tariffs and inflation freakout ends up taking us lower. Concerns about a trade war, which again, so far, we don't have.